There are two main types of assets that people invest in: equities or stocks on the one hand, and bonds, otherwise known as fixed income, on the other. When they invest in stocks, investors are buying shares of ownership in a company. That means they should benefit from the company's growth through capital appreciation and receive any dividends. However, equity investments come with higher volatility. In other words, prices can fluctuate significantly. When people invest in bonds, they are lending money to a government or corporation in exchange for regular interest payments called the coupon, and the return of the bond's face value when it matures. Bonds are generally considered safer than equities because they provide a fixed income stream and have priority over equities in case of bankruptcy, but they typically offer lower returns. Marlena Lee is Global Head of Investment Solutions for Dimensional Fund Advisors.
Fixed income can be used for lots of reasons, but mostly people use it to help reduce the risk in their portfolios. A 100% equity portfolio has a lot of volatility in it, and fixed income has less. So when you add fixed income to the portfolio, it just helps you fine-tune that volatility in your portfolio. Of course, other people might use it for things like inflation protection, or even as a way you can still pursue expected returns in fixed income. So lots of different reasons to modify one's fixed income allocation, but primarily it's used as a risk reducer.
As with equities, investors are rewarded for taking risk. So what are the main risk factors that drive fixed income returns?
Within fixed income, there's, I would say, two major drivers of what does your risk and return profile look like. That would be term, or how long the bonds in the portfolio are, and credit. So how, are you in something that's very default risk-free, like treasuries, or are you incorporating some corporate bonds, some credit premiums? And for that, you usually get a higher expected return. So those are the two major things that will define your risk and return profile within fixed income.
Most fixed income fund managers try to outperform the market by making predictions about future yields and prices. But Dimensional takes a much more systematic approach.
We're a systematic manager in fixed income, just like we are on the equity side. And what that means for us is we're looking at market prices. In the bond market, we see yield curves every day, and there's lots and lots of different yields out there on different bonds. And rather than try to predict what the Fed is going to do or where interest rates are going to move, we can use today's prices to infer a lot about expected returns. So the first component of expected returns is just what is the yield on the bond. That's going to be the expected return if you hold a bond to maturity. But of course, we don't have to hold the bond to maturity. We could buy, for example, a 5-year bond and only hold it for a year. And even then, we can compute expected returns as that yield component, plus any expected change in that yield might lead to either a price increase or a price decrease, depending on the shape of the yield curve. But we can look at today's yield curve in order to estimate what that expected additional return might be due to the price change and price appreciation.
Systematic equity investing has grown hugely in popularity since the 1990s. The growth in systematic bond investing has been less dramatic, but it has accelerated.
Just like we see a growth in systematic approaches in equities, I would love and I expect to see that to continue to grow in fixed income. I think a lot of people are catching on to the research that it's really hard to identify mispriced securities. That happens to be true on the equity side. It's also true on the fixed income side, where your traditional bond managers, they don't do a great job at beating their just passive index benchmarks. And what does that mean? It means that it's really hard to figure out where yield curves are going. So instead of trying to peer into a crystal ball to see where these yields are going to move, instead there's so much information that we can use just using yield curves today. And that's a dimensional systematic approach. And I think over time, more investors will see the benefits of such an approach.
In short, there are many reasons for investing in fixed income, but primarily it's a risk reducer. The two main risk factors are term risk and credit risk. Traditional active bond managers struggle to outperform the market, and a systematic approach based on market prices usually delivers better outcomes. Thank you to Marlena Lee from Dimensional Fund Advisors and to you for watching.